These three types of fair value gaps have the highest probability and win rate. You will never look at fair value gaps, the same you did after watching this video. Make sure to stick until the end of the video, as in the last chapter we're going to implement all the learned knowledge into a trading strategy with a high win rate. Now let's get into the video. So we are looking at a chart. We need to know if we are in lower time frames, we will have more fair value gaps condensed. The general rule is the lower the time frame, the lower the quality of the fair value gaps. Such like in this example, many beginners and even advanced traders sometimes fail to decide which fair value gap should they take. I'm not going to tell you exactly which one because I don't know either. It is a game of probabilities. So I will show you in this video the only three types of fair value gaps I would take. The first rule: the fair value gap must be created or mitigated in a kill zone. The kill zones are certain periods of time in different sessions where a lot of liquidity is placed or displaced. Therefore, the period of time with the most price manipulation. The kill zone timing for the Asian session is 8 p.m. to 12 a.m. EST, and the pairs that follow this session are JPY, but also AUD and NZD are active countries. The next one is for the London kill zone, from 2 a.m. to 5 a.m. EST. The active pairs in this kill zone are the GBP, Euro, and Gold. And the most common kill zone is the New York one, from 7 a.m. to 10 a.m. EST. The major pairs are any USD, Gold, NASDAQ, and S&P futures. The second rule is to focus on the external gaps. Let's explain. The pattern we are familiar to see is this one. We have one fair value gap that price bounces up after mitigation. In a representation, this is usually the external fair value gap, but in reality, we have multiple fair value gaps in between. These are called internal gaps. Obviously, for safety reasons, a good idea would be to only take external fair value gaps. That way, we are missing many entry levels, but we are getting the highest entry quality instead of entering on internal gaps. The first type of fair value gap is taking the second gap. So when price goes up, it leaves an inefficiency. This is our first fair value gap. So what we want to happen is for price to mitigate the first gap and eventually create a break of structure. And the most important is we want to look for a creation of a new fair value gap. The first one is usually the one that reverses or breaks a trend. But the problem is we can't know just from the first one if the gap is likely to hold or break. For that, we wait for a creation of another gap right after the first one. This is a higher probability fair value gap, and we are likely to see even more imbalances printed and mitigated afterwards. Price action is taking liquidity before pushing down. This move leaving behind a fair value gap. This is our first gap. Price consolidates for some minutes, and then fills the first gap form, which after mitigation it falls down. Now, since the first gap has been mitigated, this move itself has created a second fair value gap, right here. Price consolidation and gap mitigation to break the last low. What is even more interesting is how it falls down exactly to this bullish fair value gap and manages to do a quick bounce, taking the last swing's high liquidity. Another example, sudden uptrend leaving an inefficiency. The market slowly climbs up where probably retail traders have kept buying just to get liquidated by the following move. This movement gathers liquidity from traders and fills the fair value gap. This is our first gap. Now to have a better entry, we can move to a lower time frame in the same zone and spot the second fair value gap. We can clearly see right at the touch of the gap, price has bounced and kept slowly going up, nothing interesting yet. But soon this market gains a lot of volume. Here we don't have gaps, as all of the inefficiency has been closed by the following wicks. But we do see here a big candle whose wicks did not fill the gap. So this is our second fair value gap. Price moves sideways and eventually goes down to fill the imbalance. Point where we could buy. We have two entry types. The first one is buying exactly at the touch. In this case, it would have hit a lower but still good risk to reward ratio. Or we can entry on the 50% of the gap when the gap is very large. I use the Fibonacci tool to mark the zone. And we can see this will yield a higher risk to reward ratio, but it will also miss more trades more often. You choose how you prefer. So a quick recap of the first type of fair value gap. Make sure we are following a trend. Usually the first fair value gap confirms the continuation, but to make sure we do not get trapped, we take the second fair value gap. We can do that by going here on a lower time frame and finding gap created and mitigated right there. This highly improves the quality of the execution, increasing our win rate significantly. Because on a lower time frame, our stop loss is smaller and take profit wider. Usually traders go more aggressive on lower time frames, so that means bigger wins when executed correctly. This is the exact same entry position. On the right is the lower time frame, and on the left is the same trade but shown in the larger time frame. Now on to the second type of fair value gap. The market follows normal price action trends. Price manages to leave an imbalance that we got mitigated, which is our first fair value gap. The second type of fair value is still about using the second gap, but this time on a different situation. We want to see a clear break of structure as an extra confirmation for the trend to continue in our favor. Now, the special trick is choosing the fair value gap that breaks the last high liquidity level. Remember that we have multiple gaps formed in these levels. But when a gap is formed by the last swing liquidity high point, this is the highest probability fair value gap to bounce from and continue the trend upwards. This is an example for a second type of fair value gap, but in a bearish scenario, we look for extreme lows instead of extreme highs. In this following move, this is our extreme low. Then we look for the closest fair value gap, which is this one. There is also another fair value gap here. But remember that on a bearish market, we look for breaks of structure to the downside. Therefore, we look for fair value gaps as down as possible. And this one is closer to the high. This could be big reason why it wasn't a quality entry. But clearly, the gap closer to the lower side, it worked perfectly by mitigating and rejecting. Straight down. And just look how this market continued to drop. Now an example for the upside fair value gap. Market has been going up efficiently by filling all the imbalances. So this becomes our first fair value gap. This could have been a great setup, a very clean price action, mitigates the gap. This also creates a double bottom pattern. Sometimes we can incorporate retail trading patterns. By the way, I believe the double bottom and double top are maybe the single greatest trading patterns to learn. Price bounced after mitigation and continued the uptrend until it breaks structure of the last liquidity high. And this has formed the second fair value gap. Here, there is some liquidity left that has to get taken. And they do fill the gap here. Now remember, after the break, this becomes a usable gap. It has been mitigated right there at the retest and price broke to the upside. And the last type of fair value gap, on a bullish scenario, market goes up and retraces. Now this time it doesn't have to break of structure. It can, but it's not that important, like it has been for the past ones. The important action is that after the first fair value gap has been mitigated, we know that price rejects and goes to the upside. But on this gap style, it takes down the liquidity of the last low before actually going to the upside. Keep in mind this was only a liquidity sweep and not a mitigation. Price will eventually come back later, and then the imbalance gets filled point where we can enter E position. Market is on a downtrend. Price is broke. The supply zone is now flipped into a demand zone acting as support. So this is a strong confirmation of an uptrend that means we should look for bullish fair value gaps. And the gap is right in that zone. This red candle wants to mitigate the zone. But remember, in this third type of gap, the first swing touch is a liquidity sweep. And we can see the sweep happening once this candle's wick takes out the previous wick. Now patience, and we leave price action to eventually hit mitigate our zone. This is very strong type of gap. And now, the final strategy. Did you know that you can use order blocks and the fair value gap at the same time? This is our order block. Price has mitigated the order block already, so what we want to do is to switch to a lower time frame right at the breakout and try to spot a good entry. Have you noticed this imbalance that got filled? This is the entry execution, stop loss below the gap, and for the take profit we can switch to a higher time frame to spot potential good exits. I like to exit at swing points. This on a live trading is a very good risk to reward ratio in this specific case. Up to 11. This is all for today. Thank you for watching.